Do you feel the same as I do? There's the rumblings of something big about to happen in the stock market as the overvaluation bubble enlarges and some of the world's most influential investors pull their cash and stand on the sidelines. We may have seen the greatest example of that this year as Warren Buffett dumps half of his stock in Apple to have the largest cash pile he's ever had in history. But I want to take your attention to something else as well, which is the curiously vague terms that Warren Buffett is speaking in when asked about Berkshire Hathaway's $270 billion worth of cash holdings. Now, this is not financial advice, but subscribe to the channel and watch his careful response to that question at this year's Berkshire Hathaway annual meeting.
Just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year, you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, but we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. As businesses now, there's differences in tax factors, there's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business.
Now remember, you need to really read between the lines for what he's saying there. The truth is that especially in the last few years, Warren Buffett and his holding company Berkshire Hathaway have pulled a lot of cash away from their investments and stayed waiting on the sidelines. And meanwhile, that cash has been tucked away in risk-free U.S. Treasury bills that are short-term, to the point that Berkshire now owns a massive 3% of the entire T-bill market. That provides him two things: a slow and steady growth as opposed to actual cash in the bank, and secondly, it provides Warren Buffett the ability to liquidate those T-bills quickly in case he needs to make investment moves. That means for him the T-bill market is safer bet right now than the stock market, which is a subtle signal that he believes the stock market is way too overvalued to invest in right now. And I think this is also a perfect example of just how long-term Warren Buffett thinks, because this trend towards a growing cash pile and T-bills and pulling money out of the market has been a consistent trend since 2016. Let me show you a graph that appears counterintuitive at first, but makes perfect sense in light of Warren Buffett's investing philosophy. That yellow line shows the general trajectory of the S&P 500 in the US as it came out of the financial crisis of 2008, and underneath it is the growing graph of Berkshire's cash piles, almost in proportion to that stock market growth in the decade of the 2010s. Why would that be? Why would Warren Buffett not invest his cash reserves in a growing stock market? Warren Buffett had a response to this that I don't think should satisfy the curiosity of a cunning investor, because there's clearly something he's hid under this response of saying that it's because of capital gains taxes.
We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the government owns, the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings, and they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely, and the government wants to take a greater share of your income or mine or Berkshire's. They can do it.
Remember, this was before Berkshire Hathaway dropped nearly 56% of its Apple stock in August, causing the company's stock price to plunge 5%. just how much does that idea of having to pay a gains tax hold up in? Warren Buffett's investing moves, the vagueness in his language, and his growing cash pile only coverage on one explanation, which is that he believes the stock market right now is in one of the largest and longest lasting bubbles in a long time. The value of the stocks are not justifiable by the underlying fundamentals of the businesses, and the money printing of the last few years after the pandemic has artificially inflated many of the dollar values of the stocks. In one of Warren Buffett's letters to investors, he made it clear how he thinks when the markets signal turbulent times ahead. And I quote, "Indeed, tumbling markets can be helpful to the true investor if he has cash available when prices get far out of line with values. A climate of fear is your friend when investing. A euphoric world is your enemy." But that doesn't mean you'll lower the standard for what companies you put your money in. Warren Buffett has long been a proponent of waiting as much as you need to before you can find an investment that's truly worthwhile and priced attractively in the market.
We only swing at pitches we like, and if anybody tried to swing at every pitch or felt that because they hadn't swung at a pitch for the last two pitches, they ought to swing at the third one or something like that. There are times, and obviously, but I would say this, I would not like to be running 10 billion now. 10 million, I think Charlie or I could earn high returns on, because I think there are just a few things that happen on a very, very small scale. But if we had 10 billion, I wouldn't basically see many more opportunities than we found. Now, it's true that something like Japan we could have done if the company had a 30 or 40 billion, and we'd have had great returns on equity. But if I saw one of those now, I'd do it for Berkshire.
Warren Buffett, even at the age of 94, is willing to wait years to make the right moves, and the fact that he's not doing that right now is a message on its own for people. Arguably, that's what he did when he bought Apple stock in 2016, even though the company had already become a highly sought-after stock. Here's what Apple CEO Tim Cook remarked on the similarity between Apple's long-term vision and how it's in line with Warren Buffett's investing philosophy.
We try to be very clear that we do not run the company for people that want to make a quick buck. We run the company for the long term.
One of the shareholders who recently surfaced as having bought 75 million additional shares is Warren Buffett. Yeah. Are you pleased to have him as your shareholder?
I'm overjoyed. I'm thrilled because Warren is focused on the long term. And so we're in sync. It's the way we run the company. It's the way he invests. And so I could not be happier.
It's truly a revelation every time, because both in Warren Buffett's action and inaction in the stock market, there's a lesson to be gleaned for investors that are smart enough to pick up on it. That means that in the next few months, we'll have to keep a close eye on how his investing moves change with the changing tide of the stock market. Let me know in the comments how you process all this, because Warren Buffett is the world's most followed investor, is going to have a significant impact in the markets with any large moves that he makes.